Hello there, brilliant performance management students. I'm Steve Willis, and in this video I'm going to show you how to pass Paper PM. I'll take you through the difficult topics of the sales mix and sales quantity variances. We'll do that in the context of the past exam question Valet from June 2014. I'll show you the spreadsheet technique, I'll show you how to get easy marks, and I'll show you how to do this question quickly in the time allowed. Okay, so let's jump in and get started. I've got the past exam question open, Valet from June 2014. Now, this is an older question, so it's not in the practice platform. That doesn't mean that we can't use the practice platform to practice our CBE and our spreadsheet skills. So we're going to use this question in the practice platform to make quick work of it and go through all of the exam technique that you need. So to make the most out of this video, please try this question at home first, and then we'll compare our work. All right, let's take this question together. You'll be in the computer-based exams, you'll be in section B, you'll press the button next, and you'll get a question like this. The response option they'd give you for such a question would be the spreadsheet for sure when they're asking you to calculate something for 8 marks. So the requirement, using the data provided on these two products, we have to calculate. Again, we'll do that in a spreadsheet. The total sales mix variance, the total sales quantity variance. Now, if you remember your time management of 1.8 minutes per mark, that means this whole question, you're going to have 36 minutes to do it. I like to use 1.7 minutes per mark just to give myself a little bit of buffer time to navigate through the system, to clean up things at the end if I have to do any final guessing. Well, part A, 8 marks. That's going to be about 13 or 14 minutes. And guys, that's more than enough time to do this. Now, before we dive into this, I'd like to do a little review. And I want to review the sales volume variance with you. Now, if you don't need that review, that's fine. Just skip ahead in the video, go forward. However, if you're not clear on the sales volume variance, let's go through that quickly together. All right, imagine I have a business selling sandwiches. Steve's Delicious Sandwiches. Now, if I'm going to be a prudent business person, I need to understand what it costs to make a sandwich so I can set a price and so I can understand how much profit I'll earn after I cover my costs. As an entrepreneur, we need to have that basic information. Now, in order to do that, I'm going to estimate the cost of producing one sandwich and then the contribution that I'll earn from selling that sandwich. So I'm planning to sell my sandwiches for $1, and the food that goes into making a sandwich, or the variable cost, let's say 60 cents, right? So the contribution from one sandwich is 40 cents. Now, that process of estimating how much one cost unit will cost and how much revenue I'll earn there, that is called a standard cost card. And you'll see that in these variance analysis questions. And remember, that is really the budget for one unit. One sandwich should cost 60 cents to make. I'm planning to sell it for $1, and I'm planning to have 40 cents left over as contribution to my fixed costs and my profit. Now, I'm going to make a plan. I'm going to make a budget. A budget is a nice thing for controlling my resources. I need to understand how much food I need to purchase, how much cash am I going to need to do that. So a normal part of controlling a business is to set a budget. So I think I'm going to sell 10 sandwiches next week. Okay, so my sales will be $10. My variable costs should be $6. Okay, and my contribution should be $4. Okay, there we go. That's my budget. Now, at the end of the period, oops, I only sold 8 sandwiches. That's a bummer. However, I earned $9 in revenue, and my total variable costs were $4. So I earned a contribution of $5. Well, look at this. Every row in our actual results is different from the plan, the budget. Guys, that's normal in life. We sold fewer units than expected. We earned lower revenue. Okay, but we did have lower costs, which led us to have a different contribution. However, I see something interesting. Look at that. I sold fewer units, so the volume is lower. Okay, but my contribution is higher. Isn't that interesting? Now, as a business owner, as a controller, I'd like to drill down into this to understand exactly what was different so I can repeat any actions that gave me a benefit, or I can stop doing the things that caused my costs to be higher or my revenue to be lower. Now, we have a conceptual problem. If I just try to compare the original to the actual, doesn't really work, right? I'm selling food, so we can't say that, oh look, we can't compare the cost of producing 10 sandwiches against the cost of producing 8 sandwiches. Of course it's going to be lower. It should be lower. To draw a meaningful conclusion, we need the flexed budget in between. Guys, this is the review from the management accounting exam. We need a flexed budget, friends. Flexed budget takes the cost information from that cost card and the units, the activity level from the actual results. So now the flexed column answers the question should. When we produce and sell 8 sandwiches, we should earn $8 in revenue. 8 sandwiches should cost us $4.8 to produce, so we should get contribution of $3.2. Wow, we did get contribution of 5, so something nice happened there. Now, with the flexed column, we can start the variance analysis and drill down into this and start drawing meaningful conclusions. The first place we look is the bottom line. That's the difference between the original budget and the flexed. That's right here. Okay? And we can see that it's lower by 0.8. When things are lower, when it's a reduction in profit, that's adverse. Guys, that is the sales volume variance. Very important for your PM exam. That's why we're here doing this. This is the only time we go back to the original budget and it looks at the difference in contribution or profit from selling a different number of units. Fewer units in our case. So we can say that actual contribution is 8 lower because we sold fewer units, guys. Adverse. Now, if we come up here, we can talk about the sales price variance. And now we can say, look at this. When we sell 8, we should get $8. We got $9. That's a favorable variance. $1 favorable. That's the sales price variance. That tells us we sold at a higher selling price. Well, maybe that's why the units are lower. Maybe there's elastic demand. We put the price up, but we sold fewer sandwiches. Now, last place to go is the variable cost variance right here. 8 sandwiches should cost 4.8. They did cost 4. So that's a favorable 0.8, and that would be the total variable cost variance. Now, with this little basic report, we can understand what happened, why the actual is different from the original budget. Well, we sold fewer units, so we lost 0.8 in contribution over here. However, we made a $1 recovery from selling at a higher price, and then we made an 80-cent recovery from reducing the cost per unit. Maybe they made the sandwiches with fewer ingredients. Maybe they were cheap. They skimped on the ingredients, so maybe people didn't buy the sandwiches because they didn't look as attractive. Anyway, I digress. We were here to review the sales volume variance, and to recap, that is the difference between the original budgeted contribution and the flexed contribution. And it explains why my contribution is different from different units sold. In our case, adverse 80 cents. Okay, friends, now that the review is out of the way, let's come back to this. The sales mix and the sales quantity variances. These are both a breakdown of the sales volume variance. You need to know that. If you don't know that, there's no point in going further. So we can do the volume variance and then break it down into those pieces. So for the volume, we need a standard cost card. Okay, we need to find some revenue and some variable cost per unit. We need activity level, budget versus actual. We need that information and we can proceed. Can we get the contribution per unit? What do you think? Were you able to get that, team? Well, I was able to get it quite quickly because look at this. We have a selling price here, $50 for the full, $30 for the mini. Okay? And down here we have a CS ratio, 44.6 and 55.0. That's for the Valet and the mini. And in the spreadsheet, we can get contribution per unit quite quickly. Now, let's look at the sales mix and sales quantity variances conceptually first. Well, first of all, we will only have the sales mix and the sales quantity variances when we're selling multiple products. And that is the case, right? We've got a full, we've got a mini. Okay. Now, right off the bat, we can figure out if the sales quantity variance is going to be adverse or favorable. Now, let's just go to the number of units right over here. How many units were budgeted in total? 3.6 plus 2, that is a 5.6 thousand valets to be sold. How many did we actually do? Look at that, 4 and 3.9. So we did closer to 8, didn't we? Guys, the sales quantity variance is going to tell us the difference due to selling more or fewer total units. We sold more, so the quantity variance will be favorable. Now, the mix variance, that tells us if we sold in the budgeted ratio. And let's go to the budget. We were planning to sell 3.6 to 2, right? That's almost 4 to 2, almost 4 to 2, that's 2 to 1. But look at this. We actually sold 4 almost to 4. So that's 1 to 1. We sold a greater percentage of the mini valets. So that's going to drive the mix variance. Okay, now with this information, the prices, the contribution to sales ratios, and these budgeted and actual units, we can do the whole thing. Let's jump into the spreadsheet now and make quick work of this. So I'm in the spreadsheet in the computer-based exams in the practice platform, and I'm going to use the same layout that I would use on paper, so it's familiar to me, so it just makes sense. And first thing that we can do is get contributions per unit, because we're going to need that to drive everything we do. So let's tell the marker what we're doing. And we have two products, don't we? We've got a full Valet and a mini. And we have the CS ratios, right? So all we have to do is multiply for the full. That's going to be equal to the $50 multiplied by 44.6%, 0.446. And the mini we sell for $30. We multiply that by 55%, 0.55, and I forgot the equal sign, 16.5. Guys, it's always a good idea to break your work down into step-by-step chunks. The marking team can follow what you do. It'll be easier for you to lay out your work, and the marking team can apply the own figure rule. That means if there's any mistake in either of these contributions, you lose the credit here, but it will be assumed correct wherever else you use them. Okay, so that's important, and that only happens if the marking team can follow your workings. Now that we have contribution per unit, I can do this. I can do a budgeted contribution. Then we'll come over a little bit further and we can do a flexed contribution. Okay. Abbreviations are fine. Any common abbreviations are fine. If the marking team understands what you're doing, you're going to get the mark. But let me just make that a little bit more consistent. Okay, now, budgeted contribution. We're going to do one row for each product. We got the full. We've got the mini. So we can quickly get the budgeted contribution. That'll be equal to 3,600 multiplied by this figure here. And I'm going to lock it in with a dollar sign so I can copy paste it. That's called an absolute address. When you use that dollar sign, if you copy paste it, it will keep the cell address absolutely to that cell C3. And I can do the same thing below. That will be equal to 2,000 multiplied by C4. And I'll use the same approach, the dollar signs, locking that in. And then we can get the total contribution there. The total budgeted contribution will be equal to the sum of those lines. Okay. I will underline that to show that the bottom line there is a total. Now I can save some time. I can copy this and park it right over here. Okay, now all I have to do is change out the quantities. We have 4,000 here, and we have 3,980 here. All right, now if we come to the bottom here, we could now do a sales. They don't ask us for this. This is a bit of just review with you. I'm just showing you the big picture view here. And that's going to be the difference between the budgeted contribution and the flex. So that's going to be equal to this one, H9 minus C9. That is favorable. Okay. Now, we want to understand Let's do that next month. What happened? Why do we have a higher flex? Well, there are two factors here. It could be due to two things. One, we sold more units in total, and we proved that already. We did. Or we sold a greater percentage of the high contribution units. Okay? So what I'm going to do, and I'm going to change the color just for this demo. Okay, in the exam, you don't need to do this. This is just for the demo. There wouldn't be a mark for this. I'm going to do a revised budget here. And I'm going to revise the budget based on units. Okay, so I'm going to get the contribution here. That is equal to this one. Okay, but I'm going to increase it by the change in units. So I will multiply that, okay, by the increase in relative terms. So that's going to be 7980, right? That's the 4 and the 398 added together. So that's going to be 7980 over the original budget, which was 5,600. And look at that. Okay. So at this point, when we put another figure between the two contributions, we can break down that sales volume variance. And I don't memorize this. I do it logically. I just remember this shape. I remember this template. So I can now come here in between the budgeted contribution and the revised. I didn't change the mix. I only changed the units, right? The number of units. So that's the sales quantity variance. And that will be equal to E9 minus C9. And it's a positive number, and that is favorable. Okay, now all I have to do is the same thing. I can come over here now. So I can do the same thing now. Here we're going to look at the difference between the flexed and the revised. The total units here are the same. It's just about the mix of units. Okay, it's about the ratio of full to mini. That's the only thing that changed. And I'll subtract one from the other, and that is the sales mix variance. And that will be equal to the flexed minus that revised budget. And that's adverse. Now, I'm going to change that just to quantity just for this demo, right? There wouldn't be a difference in marks, but just to be just so there's no mistake. That's the sales quantity variance. That's the sales mix variance based on contribution. Okay, now guys, there are no marks for formatting in this exam, but let's be neat, let's be professional. I can grab all of this now, and I can just apply a little light formatting. I'll put it to no decimal places, okay, with a 1000 separator. And friends, there we have it, the sales quantity variance and the sales mix variance. And again, that doesn't look so pretty. Let me just, a little more light formatting so it looks nice on my eye. Wouldn't be a mark for that, but there you go. Now it's crystal clear to any user of this spreadsheet what my variances are. The sales volume variance, they didn't ask for that. There would not be a mark for that. I just wanted to demonstrate my approach. Okay, so we could delete that now if we wanted to. Ladies and gentlemen, there you have it, the sales quantity and the sales mix variance. If you have any questions about that, put it in the comments below. Friends, Steve signing out. Good luck on your upcoming PM exam.